Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. We're nearing the end of the year, so I wanted to go through and kind of touch on some things that most of us talk about in maybe March and April or February. And when we measure the year before at that time, it's usually on taxes, income taxes. The problem with that type of planning or lack of planning is we're looking in February, March, and April with all our 1099s and W-2s and expenses and write-offs and standard deductions as if there's nothing we could do to control those or to control that income. And really, it's just a record-keeping exercise where we add up everything that we did do. And then we look and see some of the moves that we made in the year before cost us, where had we just waited maybe until after January 1st, it might have had a different effect or something like that. So in near year end, which is where we are now, we like to, even starting October, look at the year and how the year is wrapping up, and are there different circumstances we can take advantage of before the end of the year, such as, let's say you have a high income year this year. You got a bonus. And that means, if you think about it, your tax rate might go up. It might throw you into the next bracket. So what that means to us at year-end planning is, should we, if we're self-employed, not take a pay in the final month of this year and defer it to double pay in January? Do you see where I'm going? Or the reverse. Let's say it's a low income year, or we had high expenses or unforeseen expenses. And we might want to say, if there's enough money in the budget, especially if we're self-employed, I'll start there. Should we take double pay in December and make next year a little easier? That's the type of planning I'm talking about. So first, where I want everybody to go, I want you to look at if you have any mutual fund statements or any investment statements that are not in IRAs or 401ks. I want you to look at those, and I want you to see, first off, you'll probably want to evaluate all the issues regarding your investments. Are they performing well? Are they in the right categories and all? Now, a lot of times people will say at the year end is a good time to readjust, and that's a separate discussion, but I will tell you this. Anytime you choose to readjust your holdings in any type of investment that's outside of a qualified plan, when you move, let's say you're in any mutual funds companies and you decide, I'm going to pick mutual fund number 12 instead of mutual fund number 15. I want to reallocate. So you pick up the phone or you go online and you make those allocation changes, and that's all you're doing. You're moving into international or out of technology or wherever you're going. And you say, there, I think I'm good for the next 6 months now on how I want my allocations. What most people aren't realizing when they're doing that is, every time you make a change in holdings, you run the risk of a taxable event. So let me give you an example. You hold in a mutual fund number 12, and inside that fund there's a manager managing the holdings within that fund. So they're buying and selling different positions every day, all day long anyway. And every time they buy and sell individual positions, it could cause a taxable event, either positive or negative. So they're causing taxable losses and taxable gains, even though you have no control or knowledge of that. So the first thing you want to do is look at your statements and maybe pick up the phone or look online and see what is the overall capital gains so far year to date, capital losses so far year to date. Now there's a reason I'm getting into this. Number one, when you do your allocations, let's say you look at your fund and it's up 8% this year, and you look and you see that you're only being taxed right now, if you do nothing, on 2% of that gain, because the other 6% is still deferred in there. They've not sold the securities that went up 8%. They've only sold 2% of those securities. So you have an 8% potential gain, but it's not going to be taxed at the end of this year because it's only taxed when the manager sells the positions that are up. So you can have mutual funds or any holdings that are up a lot, and you're not being taxed on them yet. And you have others that are being up, and the mutual fund manager, let's say, took advantage of those gains, captured those gains, and sold those holdings. Now it triggers the tax on those gains for you, whether you wanted to sell them or not. So what you want to be careful of is when you're doing this reallocation, I'm going to switch from mutual fund 12 to mutual fund 15. Just shuffle them around. That's all we're doing. Hey, that's a taxable event, folks. So if you have one that you sold, well, you don't realize you're selling and buying probably. But when you're moving your funds around, you're actually selling or liquidating your funds out of one of the mutual funds and moving those funds into a different one of those mutual funds. That's a taxable event. So now the whole remainder of any gains or losses that were still being deferred or held in that old fund are now being recognized. Okay? So there are unrealized gains and losses, and then they're triggered as being realized gains and losses. You will pay taxes now if any action is taken by either the mutual fund managers or you. So you could cause your own taxable event unwittingly or unknowingly. Well, let's take advantage of that situation and a benefit now that you know. We're near year end. Are there any funds that have losses? And maybe you want to capture those losses, purposely sell. And again, it's a different decision. We don't want only taxes to factor into whether you buy or sell anything. But we do want to factor in taxes in the decision before you buy or sell anything. So you look at this and you say near year end, do I have large losses or large gains that I need to recognize, take advantage of, or want to avoid? So in doing this exercise near year end, it doesn't do you any good doing this in January or February when your tax accountant says, hey, you have too many gains or too much income this year. Can you find any losses to offset that? And you say, what are you talking about? What do you mean find losses? Well, can you see if any of your other holdings might have losses that haven't been recognized yet, that if you sell out of that fund, you'll generate enough losses to offset this gain and better your taxes? Well, your question to the accountant ought to be, why are you asking me that in February? Even if I can find it, can I do anything about it now? Can I take advantage? It's too late. Last tax year was last tax year. Last tax year began on all activities and entries January 1st and ends December 31st. Everything that happened inside that window captures that year, and that's it. So when they're asking you in February to look for losses, you need to ask them, wait a minute, you need to ask me in December. So you might want to readjust how you work with your accountants or how you look at your tax software if you're doing it on your own, and do what we call a pro forma tax return in October, November, and December to look and see what are my taxes going to look like the way they're running, and do I, and indeed you do, have some control over that, what it really will end up looking like in December if I move some of the chess pieces around. That's what this is about. So this show is all things financial for a reason. Everything relates. Everything ties in. So here we go and we say in December, hey, I see that if I could find $5,000 or $8,000 of losses somewhere, I could negate that lottery winning I just had or something like that. Let's take advantage of this, and let me share something else with you near year end here. Capital gains tax rate is 15% for most people, and I won't get into the details. I've discussed it on many shows. But if you know your income tax bracket is already 15%, you might be in a situation where you could cash out something with a potential capital gain of, let's say, up to whatever your taxes show you. When you go in and do your taxes on software or ask your accountant, you need to look and say, I need to see if I had an additional 1,000 or 3,000 or 5,000 or 10,000 capital gains. What would that do to my return? Now, when you do that, let's take, for example, $4,000. Well, let's do $1,000. You do your own software and you put in all your information that's estimated for this year, because it's not actual yet, just to look at what it might look like. And then you add $1,000 long-term capital gains. Pretend it's coming off at 1099, that you'd have an additional, over what you expect, $1,000 capital gain. And when you get to the end of the return, you already did the first return pro forma based on how you really think it'll be. And when you get to the end of the return, adding the $1,000 additional capital gains long term, the number didn't change. Now, for some of you it did, for most of you it didn't. And then you go in and you look and say, wait a minute, how could the number not change at all? I just added $1,000 of taxable income, which is a long-term capital gain, theoretically. So you say, what if it was $3,000 and you put $3,000 in? What if you were to find, to your surprise, that number didn't change? And then $5,000, and not until you put $6,000 of long-term capital gains in, did your taxes change at all? Well, guess why? And you need to take advantage of this if you're interested. In December, not February. Guess why? Because as I've said in the show, any of you who are in a normal tax bracket, a normal income bracket, are probably in the 15% ordinary income tax bracket. Remember the little known rule that I explained, it's still in place. Anyone who's in the 15% tax bracket who sells long-term capital gains, the long-term capital gains rate on those are 0. So a lot of times our old advice would be, if you have $3,000 or $4,000 of long-term capital gains, find an opposing $3,000 or $4,000 of long-term capital losses and offset them. Hey, don't waste those capital losses here. You don't need them if what I just said is your scenario. So you're missing the boat, folks, by not doing year-end tax planning. You can go to the stores all you want and get that 30% discount. I'm giving you a 100% discount, and you're not taking advantage of it by doing year-end tax planning. You're doing year-end shopping. You're going to stand in all the lines and, you know, do all the gas and in the parking lots. You could sit at home and save way more to 100% buy the gifts with no discounts, fully pay for the gifts with the tax savings I'm talking about here. So go through the exercise. Give our office a call. I'll help you go through this exercise. Find out if you have a potential of saving up to 100% of the income, which you can then use that savings to do many of the other things you're doing, where you're grasping at trying to find Black Friday and Cyber Monday sales to save you 20% on your $100 item, which saved you $20. And here I am sitting here with the potential of saving you thousands of dollars and paying for the entire Christmas with these types of savings. This is important stuff, folks. So some people don't want to take the time, but as it's been said before, many people take more time planning their annual vacation than they do their entire retirement or investment or financial planning, which is a far, far greater issue. So most people wait until they get to retirement to figure all this stuff out, a little bit late. All right, now, so that's one of the year-end tax planning strategies. Remember, when you're reallocating near the end of the year, brace yourself, stop, put the brakes on and say, wait a minute. I watched All Things Financial. Jack Driscoll told me if I shift my mutual funds around, I might incur a tax liability that I didn't think about. I don't want any more taxes this year. There's another little known credit, I guess I'll call it, where we have the long-term capital gains tax rate. There's also a long-term qualified dividends tax rate. Long-term qualified dividends are also taxed at 0% if you're in the 15% ordinary income tax bracket. So what you could do is you could evaluate and you say, wait a minute, I don't have any long-term capital gains and I don't have any long-term qualified dividends. Where do you get those? So you look at that and I'll say, you know what? If you reposition some of your holdings, and I don't want you to do this specifically for taxes, but you may find to your surprise and delight some minor changes in your investment holdings that don't materially affect your investment holdings might put you in the category then that any of the dividends that you're earning or any of the interest otherwise, you can recharacterize how your investments are held so that they now become qualified long-term, and that means long-term means 12 months in the tax world. 12 months. Long-term capital gains, long-term qualified dividends might be taxed at 0. Boy, you talk about following the rules, folks. This isn't cheating. This is reading the books at the bookstore on tax planning and taking, not tax planning even, how to prepare your taxes. And you look in there and you see a seemingly innocuous statement saying, long-term capital gains rate 0. So as you're entering your taxes, you don't recognize the value of that knowledge you just got. Long-term qualified dividend 0. So you say, well, I don't have any of those. Next, I'm backing you up and say, wait. Can you get some by repositioning holdings so that for next year and every year afterwards, until the law changes, your dividends can now be long-term qualified dividends. Your gains can now be long-term capital gains. What does that mean? A lot. It means get into our office, let us help you find some of these and many of these areas for tax planning rather than waiting till February or March and finding out, do you have any of this? Do you have any of that? We need help. We need to figure these things out. All right, now here's another one. And we'll talk about this through the end of the year, but what about gifting? You're making donations, you're making charitable gifts, you're making gifts to the church, things like that. Some are deductible, some are not. Why would they not be? You're giving to the church. You're giving to the qualified organizations. What else could you do? Well, remember, for charitable gifts, you have to itemize deductions to count on your tax return. And if your standard deduction exceeds that, you're wasting the gifts. So sometimes we'll lump gifts. Sometimes we'll see you're right on the edge, on the bracket where if you tripled your gifts, you'd be able to deduct them. In addition, they would exceed what your standard deduction is, let's say. So you want to look at your gift planning and say, wait a minute, is it better for me to bunch my gifts? Take next year's gifts and this year's gifts and make them every other year, to lump them in one year and then none in the next year. I've used 2 in 1 year. There are strategies like that. So near year end, we want to think about that. We say, wait a minute, do we wait on making gifts and double up in January, let's say, to get it into next year? Those are the type planning opportunities that we look at. And we always talk about gifts to children. Well, what about a gift to a 529 plan like I talked about last week? What about a gift to a Roth IRA for a grandchild or a child? No, people aren't thinking about that, but why don't you think about that? if you're making a gift anyway, you might want to look at a benefit, especially for a 1 or 2 or 3-year-old. By 3-year-old, they're starting to realize, hey, grandma or grandpa's not giving me anything. They're giving me this silly card that says what they did, but I don't see anything. I can't play with it. So you have to be careful there. But for those of you who say, wait a minute, there's way too much gift wrapping being opened up at Christmas, I want to do something different, or in addition to that, substantial, instead of buying more temporarily appreciated toys, well, then we get into some sophisticated planning. And you might want to get into 529 plan gifting and life insurance on the children and grandchildren, 529 plans on the children and grandchildren. Maybe you even want to pay off a student loan debt on a child out of college or something like that at Christmas time. So I want you to think about year-end doing things nice for other people, even if it's not a tax benefit to you. So you look at a situation and you say, as a parent or a grandparent, maybe I want to do something nice for people with nothing in return. Maybe I just want to pay off somebody's student loan. They have a balance left and there's money that you have that you're not going to do anything with. Everybody's just going to inherit it once you pass away, and you say, maybe I can do something nice with that now. So there are opportunities near year end for you to do some planning like that too, which is gifting planning. There are just a lot of things near year end, October, November, December. We like to sit down. We like to go through different scenarios and find ways for you to either save money, help other people, help yourself, or actually, in the tax planning cases, create money that didn't exist. So those are some of the things near year end I wanted to get on the show so that some of you listening can do a checklist or come into our office. We'll be glad to review your own personal situation with you and help you find ways to pay for all of your Christmas gifts without using your own money, like I explained on this show. All right, everyone, I appreciate you tuning in to All Things Financial, and I'll be back again next week.
Securities and investment advisory services offered through SagePoint Financial Inc., member FINRA SIPC, and registered investment advisor. Insurance services offered through Driscoll Insurance and Financial Services Inc., which is not affiliated with SagePoint Financial Inc.